man. You want to break it open, and I'll go to that CNN article. Uh,
Sure. So, gosh, man, it's been the topic of conversation for quite some time, but I must say the impact is being felt
mhm.
severely, and that is interest rates.
Right.
Um, the biggest driver of the shift in the current market. Um, it's creating some panic from some sellers. It's shifting the balance of inventory, which we track on a weekly basis, and you put together a great like 2 month history of that, which hopefully we can get a glance at. It just really shows the trend.
Yeah.
And, you know, openly stated by the Fed, they are attempting to intentionally slow down the real estate market. And
Yeah.
they're having success in doing it.
Yep. Yeah. No two ways around it. I always say this, but certainly the reason why we've escalated and have decided to take a certain stand on this is, the national story. Uh, Really, I feel has hit where we are in business and in real estate with our clients, and this is a definite direction, as you said, from the Federal Reserve about what's going on.
Yeah. And they're not, not only is it the impact of what they've already done, but
Mm,
it's very much about what they have planned for the future. And they're telling
yeah,
people, here it
yeah,
comes.
yeah.
Yeah.
Okay. Well, look, so we've got, you can hear the thrilling video from Elizabeth Warren. It's great. But let me just get into it and it'll sort of get us started. Mortgage rates continue to climb as the Federal Reserve seeks to tame unwieldy inflation. The 30-year fixed rate mortgage averaged 5.81% in the week ending June 23rd, edging up from 5.78% the week before, according to Freddie Mac. This time last year, rates averaged 3.02%, and the last time rates were this high was in the winter of 2008. Fixed mortgage rates have increased by more than 2 full percentage points since the beginning of this year, said Sam Cater, Freddie Mac's chief economist, in a statement. The combination of rising rates and high home prices is a likely driver of recent declines in existing home sales. However, in reality, many potential home buyers are still interested in purchasing a home, keeping the market competitive but leveling off the last 2 years of red hot activity. Despite the jumps, mortgage rates remain well below historical highs notched during the past 40 years, notably the record 18.63% average rate in October 1981. Still, the sharpness of current mortgage rate increases combined with the spike in borrowing costs will ultimately make consumers more cautious, said Abby Omodunbi, Assistant Vice President and Senior Economist for the PNC Financial Services Group. I think we're likely to see further increases in mortgage rates through the rest of the year, Omodunbi said in an interview with CNN Business. The Fed wants to see softening housing activity. The Federal Reserve does not set the interest rates borrowers pay on mortgages directly, but its actions influence them. Mortgage rates tend to track 10-year U.S. Treasury bonds, but rates are indirectly impacted by the Fed's actions on inflation. An investor as investors see or anticipate rate hikes, they often sell government bonds, which send yields higher, and with it, mortgages rise, as well as mortgage rates. During its policymaking meeting last week, the Fed raised its benchmark interest rate by 75 basis points, the largest such increase in 3 decades. In public comments made since, including in testimony before Congress, Fed Chairman Jerome Powell said the central bank's actions should help dampen demand in the nation's housing market, which has been running white hot. Home prices surged during the past 2 years, in part due to record low mortgage rates, pandemic related migration patterns, the influence of investment firms buying residential properties, and the Fed's purchase of mortgage bonds. Rents and home prices continue to rise at double digit rates in many areas. Housing prices should stop going up at such remarkably rapid rates, Powell said Wednesday in a hearing before the Senate Banking Committee. Since the beginning of the pandemic, we've had very, very hot housing market all across the country. As demand for housing moderates, you should see prices stop going up. Still, the flip side of the higher mortgage rates in a high inflation environment and record home costs could ultimately price out millions more Americans from owning a home, according to Harvard University's annual State of the Nation's Housing Report released Wednesday. A year ago, a buyer who put 20% down on a median price $390,000 home and finance the rest with a 30-year fixed rate mortgage at an average interest rate of 3.02%, had a monthly mortgage payment of $1,673, according to numbers from Freddie Mac. At today's rate of 5.81%, the monthly mortgage payment on that same house would be $2,187, a difference of $514. Housing already appears to be transitioning to a post pandemic new normal, said George Retu, Realtor.com's manager of economic research. Rents hit a record high for the 15th consecutive month, but the pace of growth is slowing, he said, adding that home price gains are also declining. Market prices will continue adjusting to a smaller pool of qualified buyers and higher financing costs, he said in a statement. The move from an overheated real estate market toward a more sustainable one will take some time. The upside is that eventually we should see a healthier environment with more options and better value for many buyers. So a lot to unpack there. I know you read it.
Sure.
What are your first comments, Darren?
The language they use throughout is slowing the growth, sustaining the prices, and the pendulum. It's never a pinpoint target, right? It's like a shotgun method here. It's not a sniper taking this adjustment. So the pendulum's gonna swing. We're definitely seeing some price reductions, some big swings there. Some of those price reductions, which is common with a long upcycle, is just sellers that are a little too excited about what the value they think their property is, and they realize very quickly that it was probably priced too high. So I support things leveling off. I think it's healthy. We've had an upcycle for a very long time. Very long-term upcycle. And we need balance. So will that be the end result? I don't know. I don't think it's going to land there. I think there'll be a little shift. We came up with some interesting ways to evaluate the market as it relates to interest rates. And I think some of the lenders we work with, I know at least one specifically, has kind of had this dialogue with some of our clients as they consider a purchase. And it's really good to look at to determine, are you going to stay on the fence as a buyer if you're not priced out because of these adjustments? Mm-hmm. Or are you going to move forward with a purchase hoping there'll be a lower price points? It takes a pretty big movement down on prices to absorb even a 1% interest rate hike. Right. And we've already seen 2% this year. So I look forward to evaluating that and just want to have any potential buyers and or sellers, understand where the market may go and how interest rates may affect them, not only past, right, present, but future.
Well, that's the thing, that's the other thing I wanted to say is, we're going to kind of kick this off, but this is an answer, let's say, in slow motion. We're going to pick out today, for instance, Darren, I know you did some research on the comparison of an interest rate hike versus a price reduction and what that might mean. So we're going to go through that and check that out. But we're experiencing this just like you, and we'll adapt and we'll point out things as we go through the weeks of what this is. But I think you're right? Buyers and sellers are kind of caught in the middle here trying to figure this out and how they can best adapt to this new market and this new, what I'm calling normal.
Yeah. Well, just a seller example is we're working with a seller right now to get their property to market. And our research, basically, we're looking at the rate hike that just happened. Mm-hmm. Well, we want to know when the next Fed meeting is, at point at which they're saying they're going to increase potentially another 3/4 basis points. So we're advising them to get the property on the market before that bump on the Fed side happens yet again, because that would then further reduce buyers' capability. Right. And some buyers, if you're representing buyers, should also clearly recognize that and try to get something locked in before future rates, which is what we're going to kind of display a little bit of.
Okay, well, let's go ahead. So, I did some numbers from the last 8 weeks. We'll look at that as we segue into notable solds and actives for our local market. But let's go ahead. I'll open up. Let's see here. Let me open up the mortgage calculator. Take a look at what you figured out. So here it is, mortgage calculator. So go ahead and direct me here, Darren. What did you want to start with first, as a case, as an example?
Sure. Let me open mine up as well. Go here. There we are. All right. So let's first off go ahead and slide that tab over, or click on the tab that says include taxes and fees. We want taxes to be reflective in the payment.
Include that. Okay.
All right. Let's do a home price of 750. Yeah.
750. All right. And down payment 20 is fine.
Yeah. Everything else will leave the way it is. Go ahead and put the interest rate at 6%.
6%. All right.
All right. So with that at 6%, you have a monthly payment, including taxes of $45.97. Are you getting the same number on your end there, Joe?
Yes. Yeah. Yes, I see it. Mm-hmm.
All right. So, and this is what we want to show you: $45.97 payment. Let's say the rate goes up to 7%. Remember that, basically just under 4,600. So adjust the rate to 7%.
Yeah.
The price bumps by over
7%. $49.92.
So it jumps by about $400. So what does that have to equal? At 7%, what does the price have to go down to get the same payment of around 4,600? And that price was $690.
So that is a 8% reduction.
That equals an 8% reduction.
Well,
so
that might be the hope of a lot of buyers, maybe, or at least some. Oh, there's going to be some reductions here. There's going to be some reduced prices. Let me take advantage of this.
Right. That's exactly what we're trying to show here. So yes, there will be some reductions. And like everything else, those reductions are more likely to happen on maybe some of the properties that are a little less desirable. They're less likely to happen on the highly desirable properties. They absolutely are not going to happen at this point. I don't know. I can't predict far into the future, but at this point, it's not happening across the board by any means. Right.
So at $690, I left it at 7%. It's the same price as.
So it's the same price, but what you're waging, if you're staying on the fence, which is what we're trying to point out here, if you're going to wait to see if prices come down before you make a move, and the Fed is laying out potentially a three-quarter basis point hike in July. And then I think at this point they were loosely saying a quarter point at the following meeting. That's a 1% increase over that cycle. For you to have the same monthly payment, you're going to have to rely on an 8% reduction in price to have a similar monthly payment. So the question is, do you wait? Everybody always wants what they can identify yesterday. Oh, I want that. They didn't want it yesterday. They wanted the day before because it's better then. It's easy to look back and say what you want. But here we are, 6%. But we're talking about 7 in the future. Do you make a move? I think I talk about getting involved in markets where there's transitions happening. And in real estate, unfortunately, it's very hard to identify an absolute transition until you look behind you and you're looking at the historical data. But, yes, prices could go down. And if you lock in a rate now, you're probably going to have a similar payment to what you would then have in 3 to 6 months from now with higher interest rates and a lower price point.
And it's $60,000 off a $750,000 home, at least in our market. It's pretty sizable. I don't know if that's going to happen.
Look at the more realistic. I mean, you could throw in $1 million, which is more likely in our market. And And in that case, I think it ended up being like a $79,000 reduction. It was like 7 point something percent.
There's a million home price at 7%.
I'll do it at 6 first.
Yeah, 6 now. Yeah.
So 6130. Now if you jump
656.
now if you go 7 and put the price in at, I think I ended up being 921 as a purchase price. 6130. So 79,000, it's just shy of 8%. So at $1 million price, you would need almost an $80,000 reduction to equal the same payment if the interest rates go up by 1%. So,
and the magic date on this, the magic date, right, Darren, we were talking about is end of July. The Fed is holding their meeting, and July 28th, there might be an announcement at that point of, yes, this next 75 basis points increase.
Right. And as the article said, and obviously, as we know, Fed doesn't have direct control over interest rates. And as the date approaches and they're expecting, if the market is truly expecting it to happen, we may start to see rates rising just approaching that. But yeah, I mean, they're not in parallel, but they're very close. So yeah, the end of July, about a little more than a month away, is when the next rate hike could happen. So it's real, and that might be a window in a transition to catch an opportunity for a seller who has bigger concerns about a market reduction, is willing to sell something at a lower price. You know, if you catch it just at the right moment. After that, I don't know. I don't know going into the fall and winter. They're definitely talking about just the ultimate goal is try to slow down the economy, curb inflation. But if you end up watching that video from that article we just read, you know, or watching it somewhere else, it is Elizabeth Warren talking to the Fed and acknowledging that they're basically trying to slow down the whole economy. And who's that going to hurt first? The service industry, the low-paying jobs.
Well, okay, and that when I watched the video, and guys, I did put the CNN link in your comments, so you can check it out later. But yeah, what I thought of was people that don't necessarily own homes.
Absolutely, that's correct. This is why we push for home ownership, as crazy even as we believe the prices are. It's really how to build wealth in this country with the way the tax code works. So yeah. It is those who are most in need. Our system is still very biased towards those with wealth.
Right. And that was the warning from Elizabeth Warren. Like, careful, man. Careful.
Yeah, it's true. They protect their policies are trying to create a certain overall economic level of production. But it also, you know, in doing so, it protects the wealthy.
All right. Do you feel we can end on that, or what do you think?
Yeah.
Okay. All right. So again, guys, to be continued as usual.